So, if you just opened the SIPP and you're excited to get started, don't make any big investments till you've at least watched through this video and then potentially been to see a financial advisor as well. Right, so let's get real for a moment. Your SIPP, your self-invested personal pension, it's supposed to be your golden ticket for your personal superpower for financial freedom and retirement, right? It's the vehicle that's meant to drive you towards those golden years, giving you control and flexibility over your investments, along with some pretty nice tax benefits as well. But what if I told you there's some sneaky little traps lurking in plain sight that could turn that dream into a financial nightmare? For most people, low-cost index funds are going to be the answer. However, for some, that just isn't enough and they want to get much deeper into investing. So this video is for those that want to dig deeper. Though my general advice would be low-cost index funds, much safer. I've been knee-deep in my own SIPP paperwork, my investment statements for the last few months, and the very foundation of my own family's retirement plan is at stake. And honestly, I was shocked. I uncovered 4 costly mistakes I think that I was close to making myself. And if I, someone who lives and breathes financial planning, almost stumbled, then I know many of you might be facing similar risks. Now in this video, I'm pulling back the curtain on these 4 traps so that you can protect your pension before it's too late. So stick with me because we're going to get sorted together. If you haven't had a chance to have a look yet, have a look at my course at timetoretire.co.uk. Talk all about pensions and the transition into retirement. So welcome back to the channel, Future Retirees. If you're new here, I'm Eric, and since I retired early this year, I've had the privilege of helping a few of you guys with their retirement and their retirement planning. But today we're cracking open the SIPP handbook, and while a SIPP can be an absolute game changer for building your retirement wealth, offering a wide range of investment options and significant tax relief, it's also a tool that demands attention. With great control comes great responsibility, and there are some common pitfalls that could seriously dent your retirement dreams. And trust me, you don't want that. So, what we're talking about? We're talking about a vehicle called a pension designed for those who want more direct control over their investments, moving beyond the ready-made portfolios of a traditional workplace pension. Now, this is fantastic, it's flexible, but it means the onus is on you to make some smart choices. So let's dive into the 4 biggest mistakes that could sabotage your retirement, and more importantly, how to fix them. So mistake 1 is putting all your eggs in one basket. Now this is a trap that I almost fell to, and it's a classic. It's failing to truly diversify your investments. It sounds obvious, but don't put all your eggs in one basket. Yeah, many people start their SIPP with the best of intentions, perhaps investing in a few companies that they know or a sector they believe in, and they concentrate too heavily on those few stocks or sectors. Now that's a recipe for disaster. Now imagine you've poured a significant chunk of your retirement funds into just one hot tech, or even a single property venture. If that company hits a rough patch or the property market takes an unexpected dive, your entire retirement plan could be seriously jeopardized. You're essentially betting your future on a handful of outcomes, and in the unpredictable world of investing, that's a gamble you really don't want to take. So what's the fix? Well, spreading your bets wisely. Now, diversification isn't just a fancy financial term, it's a fundamental recipe for managing risk and smoothing out your investment journey. It means spreading your investments across various assets, sectors, and even geographical regions. Now, think of it like this. If one part of your portfolio is underperforming, another part might be thriving, balancing things out. Now, this approach reduces the impact of any single investment's poor performance on your overall portfolio. Channel members actually get to look inside my SIPP every few weeks. I open up my SIPP whenever I make a trade generally and show you what trades I made with my SIPP and why I made them. If that's of interest, consider clicking that join button and becoming a member. What does diversification look like in a SIPP? Well, don't just stick to stocks. Consider a mix of equities, shares, bonds, government or corporate, commodities like silver, gold, or even real estate through REITs or property funds. And each asset class reacts differently to economic conditions, and that provides a natural hedge. For instance, bonds are generally considered lower risk and can provide a steady income stream, potentially offsetting stock market's volatility. Within equities, diversify across various sectors instead of going all in on technology. For example, spread your investments across healthcare, finance, consumer goods, energy, industrials. Or if the tech sector then faces a downturn, only a proportion of your SIPP will be affected, while other sectors might be performing well. Now, don't limit yourself to your home country. Invest in different countries and regions like the US, Europe, Asia, emerging markets. Economic events can impact different markets in different ways, and global diversification helps protect your portfolio from those localized downturns. Consider a mix of growth stocks and value stocks, or even dividend-paying companies. Funds and ETFs are a fantastic tool for achieving instant diversification across many companies and sectors with a single investment. So take a moment right now, assess your SIPP, pull up your latest statements. Are you relying too heavily on a couple of investments? If so, it's time to rebalance. It's about building a robust portfolio that can weather market storms and keep you on track. So that brings me to mistake 2. Which is neglecting a clear investment strategy. So the second mistake I noticed, and one I personally wrestled with, was a lack of a clear, well-defined investment strategy. When I first started my SIPP, I admit, I jumped into a variety of investments without a cohesive plan. It was a bit like throwing darts in the dark and hoping for a bullseye. This led to confusion, missed opportunity, and sometimes overexposure to volatile growth stocks without a clear purpose. Now, what was I trying to achieve? How much risk was I personally comfortable with? These were questions that I hadn't really fully answered for myself. Now, without a strategy, you're essentially investing blind. You might chase the latest hot stock, panic selling during the dip, or simply accumulate random collection of assets that don't actually work together. This kind of reactive investing can be really detrimental in the long run. Now, creating a clear, adaptable investment strategy is really essential. It doesn't have to be overly complicated, but it needs to outline your goals, your risk tolerance, and how you plan to achieve them. Think of it as your SIPP's roadmap. Now, here's what you should consider when building your strategy. When do you want to retire? How much income will you need? Now, these are questions that will inform how aggressively or conservatively you should invest. Assess your risk tolerance. How much market fluctuation are you personally comfortable with? How much will keep you awake at night? Your risk tolerance should guide your asset allocation. Generally, younger investors with longer time horizon can afford to take on more risk, while those closer to retirement might prefer a more conservative approach to protect their money. Now, for asset allocation, this is where the rubber meets the road. Based on your goals and risk tolerance, Decide on the proportion of your SIPP funds to allocate to different asset classes. For example, you might go 60% equities, 30% bonds, 10% cash. Now consider the balance between growth and income stocks and your exposure to the domestic and international markets. Review and adjust them regularly. Now market conditions change and your personal circumstances change as well. Your investment strategy shouldn't be set in stone. Regularly review the portfolio, perhaps once a year, to ensure that it all still aligns with your current goals and your risk tolerance and the market outlook. Now, don't be afraid to rebalance your portfolio to maintain your desired asset allocation. We also want to protect against inflation. So over the decades, inflation can significantly erode the purchasing power of your savings. So consider including inflation-protected securities like index-linked gilts or inflation-linked bonds, ETFs. And if your provider offers them, well, why not take them? Ask yourself, what are my financial goals? Am I prepared for market fluctuations? Do I have a plan for how I'll react to good and bad news? Having a clear approach can significantly enhance your investments and help you stay disciplined as well. So mistake 3 is overlooking small costs. This is the silent wealth eroder. Now, this is a sneaky one. It's often overlooked because it seems so insignificant at first glance. Now, ignoring the associated costs with your SIPP, many people don't realise how even seemingly small fees can accumulate over time, and it quietly eats away at your hard-earned returns. You might look at 0.5 or even a 2% annual fee and think, well, that's tiny, it won't make a difference. But it does. And that's because of compounding. These small costs can erode your returns significantly over the decades. And we're not talking buttons here. We're talking tens, if not hundreds of thousands of pounds over the lifetime of your pension. It's like having a slow leak in your retirement boat. You might not notice it at first, but eventually you'll find your feet are very wet. A recent survey even revealed that a staggering 83% of UK savers don't fully understand what they're paying in pension fees. Now that for me is a huge problem. What's the fix for that? Well, become a fee detective. Take the time to genuinely assess your SIPP provider's fee structure. Don't just look at the headline figures. You need to understand all the associated costs, and these will include your platform fees, which are the charges from the provider for managing your SIPP accounts. And these can be flat monthly fees, which often benefit larger pots, or percentage-based ones, which can become very costly as your pot grows. Then there's fund management fees. Now, these are the fees charged by the funds you invest in, often ranging from, say, 0.1 to 1%, or even sometimes more per year. These are separate from the platform fees and can be substantial. Then there's dealing and transaction costs. Do you pay a fee every time you buy or sell some shares? These can add up quickly, particularly if you're an active trader. Exit or transfer costs. What if you decide to move your SIPP to another provider? Are there fees for that? What about drawdown fees when you start taking an income in retirement? Some providers charge specific fees for managing that drawdown. The cost drag from these fees can silently drain your investment value. For example, a 0.5% annual fee on a £100,000 SIPP means 500 quid in charges every year. Now, over 20 years, that seemingly small percentage could reduce the value of your final pension pot by £40,000, or even more depending on growth assumptions. Now, ensure that your provider offers good value for money, not just the lowest headline fee. And you can always send me an email. I'll give you the latest on what I know about what the providers are doing. Now consider this. If you could save just a fraction of those fees by switching providers or negotiating, what could that mean for your retirement? Every bit counts, especially with the power of compounding. Don't ignore the details. Your future self will thank you. Now, the final mistake 4. Mismanaging investment choices. This is one that trips up many investors. It often stems from a desire for a quick win or misunderstanding of risk. Many investors choose stocks based solely on high dividend yields or past performance without truly considering the underlying risks involved. Now, a high dividend yield might make a stock look incredibly attractive. I mean, who doesn't love income? What if a company's shares price is steadily declining? You could end up with disappointing total returns, as any income gained is often offset by capital losses. Similarly, past performance is never a guarantee of future results. Now, chasing last year's top performer often means buying high, only to see it potentially cool off. Furthermore, some investments available in a SIPP require a level of expertise and risk tolerance that many casual investors simply don't possess. We're talking about things like private company shares, hedge funds, or direct commercial property. While these can offer high returns, they also carry significantly higher risks. They can be illiquid and they may not be suitable for the average SIPP holder. So what's the fix for item 4? It's about being informed and taking professional guidance. So balance your portfolios. Don't just chase dividends. So while dividends are great, don't let them be your sole focus. Balance dividend paying stocks with a growth stock and other assets. A diversified approach, as we discussed earlier, is key. Now understand that the total return, capital plus dividends, is what truly matters. Understand what you're investing in. If you don't understand how an investment works or the risks associated with it, don't invest in it. It's that simple. Avoid complex investments like private equity, venture capital, hedge funds, or illiquid commercial property unless you're an experienced investor with a deep understanding of these markets and a high risk tolerance. They often come with higher fees and can be incredibly difficult to exit if you need to. Continuously review your SIPP portfolio to ensure it aligns with your current risk tolerance. Also, your investment goals and market conditions. Your risk appetite might change as you get closer to retirement, so your investments therefore should adapt accordingly, potentially shifting towards lower risk assets as you reach retirement age. And the final most important thing here, this is huge. If you're feeling uncertain about complex investments, formulating a strategy, or even just navigating the SIPP landscape, don't hesitate to seek professional advice. A qualified financial advisor can help you define your goals, assess your risk tolerance, build a suitable strategy, and make informed choices tailored to individual circumstances. It's better to be informed and get expert guidance than to risk your future by making uninformed decisions. And remember, a SIPP offers you a wide range of choices, but that freedom comes with responsibility of making good choices. Now, I'm not a financial advisor. If you do want to see one, make sure they're independent. So, in conclusion, take control, secure your future. So the 4 costly SIPP mistakes that can destroy your retirement. 1, failing to diversify your investments. Neglecting to create a clear investment strategy, overlooking seemingly small costs that silently erode your wealth, and 4, mismanaging your investment choices by chasing returns or dabbling in overly complex assets. Now, by being acutely aware of these common traps and actively working to avoid them, you can significantly safeguard your financial future. A SIPP isn't just a pension, it's a powerful tool for retirement wealth accumulation, but only if you're proactive, informed, diligent, Don't let your hard work go to waste. Take control of your investments today and ensure that you're on the right, well diversified, strategically planned, cost efficient path to a truly secure retirement. Well, I hope that was useful. Don't forget the low cost index fund option. See you on the next one.